Hello friends, thanks for tuning into my channel. Now, today I want to talk about IPO investing. Like a lot of retail investors in this country have a mad rush towards IPOs. They feel that this is their moment of making money. They will invest maybe that 15,000 rupees roughly, which SEBI mandates for a lot of bidding, and then they will return maybe a 25,000 and make that 50% or 60% return in a couple of weeks' time. Now, I do not quite subscribe to that view of how IPO investing has become in this country. It's become like a shortcut to minting money. It's perfectly fine if you're a trader and you look at IPOs that manner, that this is a quick turnaround of the money invested. That's a completely different way. But if you're an investor and if you believe that you're investing in good long-term stocks, and that's the reason why you're looking to grab the stocks in an IPO or even at a pre-IPO stage, which is like largely dealing with unlisted stock, I think the method of looking at the stock needs to change. The first parameter that you should look at, even when a stock comes in an IPO stage, is what percentage of that is an OFS, which is offer for sale, and what percentage of it is an issuance of new share. Like this gives you a fair bit of idea is that why that IPO is being done in the first place. If you see that a percentage of OFS is now exceeding a 15 to 20% percentage of the total issue size, that is a very clear red flag, because essentially what is happening is that the IPO is just becoming a mode of exit for the existing investors who have invested in the same company at an early stage. Whereas if you find that in a different IPO that the percentage of the OFS is roughly about 10-15% or so, that's a good sign that the large percentage of that 85% of the funds that's being raised via the IPO route is going to be used for business expansion and other areas. That's a very positive sign. The second thing that I kind of looked at is what is the moat of the business, how replaceable the business is, which is one of the particular reason why I dislike investing in FMCG IPOs. And the reason behind it is an FMCG brand can easily be recreated. There is practically nothing moat about it or nothing proprietary that cannot be replicated out. If tomorrow you have a fairness cream, someone else can make a similar fairness cream. If tomorrow you have got a lipstick, you can create something similar. Or if you have some sort of a noodles packet, I can create something else. Okay, and brand building is a long-term process. It doesn't happen overnight. That just a company which goes into an IPO has a successful brand behind it. I completely disagree with that. I think it will always have disruptive brands which will enter the space and create their own moat around. I don't see any reason why FMCG companies should be valued at a very high premium compared to their book value. I don't see any moat about it. The moat really essentially comes up if you have that solid distribution line. If you know that you have got that one or two essentially key products, which are your hero products, which generate roughly about 70-80% of your total sales, and where you dominate that market space, you dominate the market, you have maybe say 50% share in that particular subcategory. In those cases, yes, those IPOs stand apart. Those IPOs are something where you could look at investing in. Okay. But having said that, I don't see any reason why there should be a mad rush towards it as well. Now, the second important thing which I was coming back to is essentially the profitability. Like many companies these days don't run for profit, they run for user base. And the general proposition is India is a huge country. We have got 140 crore population. Eventually, everyone will start using our products. We will capture 10% of the market share. That will give us 14 crore users, and so on. I think the story is built around this very narrative. I find it completely absurd. I think a business has to be profitable within 3 years of its running. I don't see any reason why a business can be sustained just by pouring in investor money and then essentially giving them an exit in 2 years' time, then getting the retail investors' money, and the cycle kind of goes on. Eventually, it reaches a point where it just gets acquired by some other company purely because of the brand value that it has. I don't believe in investing in these kind of companies. The third important thing is looking at certain key characteristics, is looking at the cash flow of the company. If it's operationally cash flow positive, how much is EBITDA margin? What percentage of its total revenues is it spending on marketing? Now, there are companies which have had very successful IPOs which spend about 40% in marketing. They are actually selling each and every unit at a loss. and yet they're getting valued at such astronomical multiples. I feel there is no solid justification for this, and this is where the market needs correction. I think over time, the retail investors in India will get smart and they will start looking and evaluating companies before investing in IPOs. Presently, I think they're misguided. A lot of mutual funds essentially also invest a lot in the IPOs. Then there is IPO funding also, which banks now extend to its HNI clients, and the rush is essentially on, and which kind of pulls up the value for companies which have got very poor fundamentals. I don't believe in investing in these companies, and as an investor, I find that you too should evaluate the companies very thoroughly before investing. Having said that, I mean, look at companies whenever you're investing, whether it's an IPO route or whether you're investing in a listed entity. Just look at the fundamentals of the business, how the result has been over a longer period of time. Don't look at it just a 1 year period. Look at it over a 3 to 5 year period horizon and how the business has been. What are the growth plans of the business? How successfully it has implemented in the past, similar challenges that it has faced, and how easy it is to replicate its business model. Which essentially implies the barriers to entry. If you find someone who is building a monopolistic business, obviously that's an IPO you should not miss out. Monopolistic businesses are extremely good, and that's an area that you should always look at. And look at the business fundamentals, look at factors like Petrosky score, and I will talk about Petrosky score later on in my future episodes. That's an area which I evaluate how companies should be looked at before investing, and I will try to share out my fundamentals of investing in business. Thanks a lot for watching. Do share your views, comments, and subscribe to the channel. Your support means a lot to me, and I hope that I've been able to add 2 cents to your knowledge for you spending a valuable time on my channel. Thank you so much once again.